All right, we're live. What's up, chat? What's up, everyone here? Today we're gonna have a debate between Karl and Justin on Joe Biden's Fed policy. Should be a great discussion between two parties. Should be great to hear different sides of the story. And I turn it over to Justin and Karl. I want to say thank you for coming on to our channel, Karl, today, and I hope it's a great discussion.
Yes, I'm looking forward to it, guys. Thanks for having me on.
Yeah, excited to challenge you. I guess you can have if you have an opening statement, you can go first.
No, you can go for it. I don't have any opening statement.
With recent inquiries of Biden's federal chairman elect, our person he wants, he's increasingly deciding that he might want to keep a 0% interest rate to help COVID stimulus. A 0% interest rate has been a debate going on for years between many Keynesians, post-Keynesian school economists. I think this kind of legislation and kind of Fed policy is detrimental to the business cycle and will create tons of malinvestment.
Yeah, I think that I think that as of right now, interest rates are they're basically zero right now, aren't they? I think that it's obviously not sustainable to keep them like that. I think that the Fed, I'm definitely not going to defend like what the Fed has done in the past months. I think that the beginning of buying corporate bonds has been incredibly detrimental. I mean, we have essentially seen the stock market socialize in many regards, and just with the way that the government responded with backing of corporations and everything, I don't think that that's necessarily a good thing. But I think, what is your proposition, I suppose?
Free banking. Basically, do you know what the natural rate of interest is?
I'm assuming it's just whatever the interest rate would be set in your idea of like a free market.
Yep. So it's like consumers basically. So you have money demanding. So money hold demand, and then the money hold demand is basically what the money in circulation goes through, and then around that demand is where you find, basically through barter, I guess you could say, what these interest rates will be based on. Well, the bank doesn't want to lose money, but I also want to increase my production. So that's how you find out real resources and real capital. The issue is without having this exchange going done and done on artificial levels, we can see Biden has been notorious for this plan. In 2009, him and Obama put interest rates below 1% pretty much through quantitative easing. This had to create massive expansion, but it was all for naught. It was not off real capital. It was all based off of basically fake recessions. So Q, which is linear outputs, right, basically had absolutely zero capital to back up the actual production going into higher production stages. So you had Q, which is the original production stages to get to consumer goods in the Hayekian triangle. As these went up, you would see that each of these returns is based around interest. However, the interest rate was not actually showing real market demands and real capital. So they're expanding without real capital, without real savings, without real capital to actually take over. It's called a bridge of savings to increase capital production and capital output through increasing capital value through time. So what happens with time is the demand stayed the same, interest rates stayed to lower. Then what happened is we're going to see production without capital, which is inevitably going to create malinvestment.
Now, so you are against, I suppose, any sort of stimulating effects that the government could enact to lessen the severity of a recession.
Absolutely. I believe that most recessions throughout history have either been due through external factors, such as like COVID was completely due to just bad effects, just unnatural thing. No one could really control that. But things like the 2000.
But the government could lessen the negative effects of COVID. I mean, our government didn't do a good job of that, in my opinion. But like governments, across the world, many did do a good job of using government to lessen the negative effects of COVID.
And I would say that if they're doing this lessening effect by lowering interest rates or increasing inflationary policy, it's going to eventually hurt them in the long run. You're going to have lots of malinvestment, which is just going to create higher unemployment rates. We can see this happen in the Great Depression, basically. When we tried to stimulate the economy by lowering interest rates, and it supposedly created a boom, right? We had lots of hope. After the 1921 recession, we decided to expand, right? We lowered interest rates extremely low. Then what happened is, well, we had a bunch of malinvestment. We had Q3 through 7, which is the production phases. They were all very producing on high outputs. However, this output was not with savings. So
I think that no, I think this is very much an oversimplification of what happened in the Great Depression to say that that was purely a product of lower interest rates. I think that it was, frankly, is a product of lack of regulation. I think that we can see that pretty clearly in the 2008 financial crisis as well. I'm sure that you'd say that that's also the response of government, but we saw a deregulated, massive deregulation prior to 2008, and then sure enough, it led us into one of the worst economic downturns that we'd seen in a incredibly long period of time. And I think that, if we're going to talk about, like, I'm sure you're in favor of like abolishing the Fed. I think that would dive. While I don't agree with how the Fed is currently being run, I'd like to see a much more democratic process. I'd like to see, our government as a whole not bought out by corporations and everything. I don't think the answer is to give all regulation power to corporations. I think that we just need better regulations.
It's not quite regulation power. It's kind of just basically free money. But I'll go on the first thing with the 2008 recession. You said that it was due to deregulation, where I don't necessarily disagree. What?
The repeal of Glass-Steagall.
Yeah, I don't necessarily disagree that it was possibly caused by this, but it was basically another thing doing to monetary disequilibrium. We had extremely low interest rates. We had extremely high inflation, meaning these banks didn't care about their backs, meaning they could loan, and they could predatory loan without any downfall, and they eventually caught up to them. They lost lots of profits due to this, and this is why it all basically fell through. Again, capital, as we can see in the later stages of production, didn't have any demand for it, so housing crashed, housing was unfinished, the lack of resources and savings occurred.
I feel like you're making a case more for just not bailing out corporations and bankings in the way that we currently are, and maybe perhaps that doesn't mean that we just do nothing. I think that it just means that the way that we bail out institutions needs to be more centered around the people and not just bailing out the large banks and then letting them do whatever they want with the bailout money. I think that that's like not like I get
of course.
How we handled it was good, but like that doesn't mean that the answer is to just do nothing.
It's I believe that all Fed changes are bad for the economy. I think it needs to be based around how consumers and investability works. When basically Hayekian free market banking is, I'll just say the gold. It's kind of like a gold standard with competing banking.
I mean, you can't go to the gold standard. There's not enough gold in the world to support the economy we have today.
No. So it's not the gold standard per se, but it's how the gold standard was run. The gold standard was run based off reserves. So let's say 1 ounce of gold was equal to $1. It's not actually how it worked, but you could put this with gem, rubies, or even fiat, just based around $1 is based around whatever subjective value you have. But each independent banking system has its different dollar that it's basically centered around. So you could even say it's called commodity reserve, basically what Hayek put it as. There's no Federal Reserve, but it's basically based around free banks. Free banks give out these currencies to invest.
So you want people operating on multiple different currencies?
Yes.
You don't see that as are you like proposing some sort of like anarcho system where there's like no government? Like, how are people?
It's kind of irrelevant to that. It could be possibly with or without a government.
In many ways, one of the main things that gives money value in our current system is the fact that you can pay taxes in it. So I think that definitely relevant. The idea of like, if you're just going to have like, why would I take this one bank's currency over another? Like, what there has to be some sort of reason that we're all taking these currencies.
Yeah, of course, I'm anti-taxation. Austrian schools is very anti-taxation, so it's not taxable. It's not taxable income.
You're getting all taxes, so no government.
But yeah, basically,
Pure anarchy. Okay, I feel like that's relevant. I think that would be a complete and total disaster. What is this? So how could you go deeper into this?
So when you have competing currencies, you are able to have a stable currency because, well, no bank is going to want to increase their basically reserve rates lower because these reserve rates are contingent on people. So let's say people want more money. So the banks are all going to increase their money supply until they're holding demand. The issue is when you have the Federal Reserve, they do this, but they can continuously keep doing this without any competitive, basically stopping power. You want stable currency, you want the most highest valued currency. So through this, you're going to want to keep your currency stable to increase investments and to, of course, as a bank, increase your profits. If you continue,
you're against? Would it be fair to say that you're against like any form of inflation? You'd like to see like more like deflation?
No, definitely no. Deflation is just as bad as inflation, in my opinion. I'm for stable currency, stable rising currency.
A stable, right? So you but that's the thing. I think that you can have more managed inflation, more with a Federal Reserve. I don't see how you do this with a purely like anarcho system.
Yeah, I was about to get to that. Okay. So as you have these banking systems, they are going off reserve rates. So you loan your interest rates, etc. You're loaning out to people. As you loan out to people, you do not want to inflate beyond people's demands. This is going to make losses for you. You are not going to get as much in return. So the other banks, businesses are not going to accept your loans. Meaning, let's say you're trying to give to Bank A as in your Bank B, but you inflated your currency way too high. Bank B is not going to trust you. Therefore, you're going to lose banks and you're going to lose customers. They're all going to pull out.
I am not following exactly on why that would. Could you go? I feel like this is purely you're just saying that like it will happen because like demand will leave it that way. Don't you see what they're?
No. It's not just demand. It's also that if it does happen, like let's say it happens, it's not. They're going to pull out. Like they're going to pull out their money. Like they're going to inflate. They're going to see that they can't possibly exchange through this inflated currency because it's no other banking system, no other person is going to trust that currency for long-term investments. So they're going to have to pull out.
How many currencies do you see in this system that you're describing? Like, I mean, don't you see that this is rather suboptimal? I mean,
no, you can have. It's really based on you could have possibly 3. It doesn't really matter.
Well, I think it's actually very relevant. I'd say one of the positive things is that you can go and you don't have to worry if like a certain store doesn't take the currency that you use.
It's most of it's based around, again, like reserve rates. So whatever the reserve they want, you could have gold, silver, you could have tin, copper, whatever the actual reserve is. So you could have, let's say you have $1 based on one amount of copper.
But not everybody's going to be using dollars. I understand that you're saying that different banks will have their reserves based on different commodities, but I'm saying if not everyone's using the same fiat currency, that's going to create many optimal scenarios for people.
It's not fiat currency though. It's based off of.
Maybe I misused the word fiat, but obviously you're not advocating that people like physically trade with gold. You're saying that they use some sort of like paper money backed by gold. Is what you're saying?
Yeah. That's how the yep. So yeah, let's. I think the scenario you're talking about is, let's say one person has silver, one person has gold. We've seen dual currency systems throughout history, and it worked the same. We had a basically reserve ratio for what these things are valued at through society. So you would have, let's say,
when did we see this operate without a government though?
Without a government?
Yes.
Ireland and Scotland around the early 1800s.
I've heard people try to reference that as like this like anarcho system before. I've heard
it was an anarchy. They just didn't have really taxes. Not many governments had taxes, but we saw they had very stable inflation. It was based around market demands, and they really had, I think, only a few recessions, and they're mostly based around externalities.
So, but I think that there's some like huge shortfalls that come with this. So say that you're using this currency and then it goes under. And so you're, through no fault of your own, you just decided this is the bank that you're going to use, this is the currency that you're going to use. And now all of a sudden everything you own is worth nothing anymore, or like at least the money in terms of that is worth nothing anymore.
No. So you still have reserves. So if it goes under, you still have X amount of gold.
No, but without the lender of last resort, that is, the Federal Reserve, I think that there are absolutely going to be banks that go under.
Yeah, there could be banks that go under, but they still have reserves that they have to give back to their customers.
No, but there would still be like this used to happen before the Fed. It was 1907. There was a giant banking run. That is why the Fed came about, is because banks would go under, people would lose everything, and we're like, we can't have this happening. People who, through no fault of their own, were losing their savings. We can't have that.
Yeah, I don't quite agree with the bank system we had before, because it was not based off competition. So if a bank goes under,
not based on competition.
What do you say?
How is it not based on competition?
Because they still had a sovereign currency.
Like where we were all using the same
yes.
currency. How does that mean that there's no competition between the banks?
The banks, no, the competition in currency is what I'm advocating for. So
why is that better though?
So as you have you have the bank, right? They give out whatever. And if this bank gives out this currency and they inflate it, or they go under, they have a devalued currency, they have to give these reserves back to the people, which is gold, which is real capital, real actual value. They give back to the people if it goes under.
And who's enforcing this though? You support like this anarcho system. Who's enforcing the idea that they have to give this back to you?
This is through rights enforcement agencies. Or I'll just pretend, I'll just say I'm a minarchist, and it really makes no difference.
Well, no, I actually think it's actually a very big difference, because
sure. I really don't want to make this any sort of anarchy debate. Just say I'll just say I'm a minarchist, and say you have a government basically forcing through law systems that you have to give it back. you have to give it reserve.
What means though? I mean, now we're talking. Now we're talking to some areas that I like. This doesn't sound like the system you're referring to. Now we have this a government that's enforcing that these contracts have to be upheld. Now what are we talking about?
So no, this is the contract of the reserve system. So you have let's say you have your dollar is based around 60%, 60% reserve. So you have for each dollar it's worth, let's say 6 ounces of gold, or I'll make that better. $10, right? You have 6 ounces of gold to back the $10, and the 4 extra ounces would be fiduciary. So let's say the bank goes under. You still have real value there.
But not all of your value though.
No, yeah. You do lose some, but it's not. Again, I'll get this. Let me finish this here.
Okay.
And then you have the 6 ounces in gold back that you can put in other banks. The issue is what causes banks to go under. It's usually inflationary practice or over lending. So over lending services under competition currency is not a very viable option. A lot of the issues with overinvestment and malinvestment are due to monetary things. You have an inflated currency.
Such as?
What?
Such as?
Okay, so you have an inflated currency, and you are going to see that you do not have the quite understanding in the economic you can't economically calculate with inflated currency as well. So you say, let's say you have person A is giving and investing to person B, right? With an inflated currency, through time, right? Investment takes time. Your value of your investment tends to go down with inflated currency. So now,
if you want, that will encourage people to invest now, like in the future, not to sit on their money. It'll encourage them to get their money out, get their money working, get their money moving through the economy.
Inflated currency.
Like if you know that the dollar that you have today is going to be worth 98 cents tomorrow, then I would encourage you to spend the dollar today.
Yeah, but then savings is also very needed in the economy.
Honestly, is important. I'm not advocating for just rapid inflation, but I'm saying that it's the idea that that's why inflation to a limited extent, you need a little bit of inflation is a good thing that can create investment. I think that was one of the problems with the gold standard is that as the economy grew, it incentivized hoarding of money. I think that, it's kind of the same problem you see with Bitcoin. Bitcoin, people don't really use Bitcoin because they're hoping they use it as an investment rather than an actual currency.
So again, I'm not advocating for an old gold standard. I'm advocating for a commodity reserve system, but
you want it to be based on something like gold.
But again, and savings is like you need a lot of savings to expand. When we tried to expand without savings, we saw something here. I don't know, hold on, let me turn my camera on so maybe I can show you the model that I'm referring to here.
Yeah, I think there's a share your screen option.
How do I flip my camera?
Well, I have no idea how you do that. If it's on your laptop or something, I know there's a share screen thing though.
Okay, can you see it?
It's just good enough.
This is where my thumb is right here. That's
okay.
The equilibrium rate. So this is savings right here. This is consumption. In order to expand, this is overall output right here. That curve right there. In order to increase overall output, this must go down for savings. Without that, to increase savings. So this savings right here is increased, and then it goes up over time. Or you can have the equilibrium rate, and it will go up over time. The issue is without savings, when it happens with a lot of inflation, is consumption would stay high, yet we would still try to expand. That is somewhat in terms of contradiction. You can't expand when you don't have actual capital to fall back on. So now we have, again, we'll go to the Hayekian triangle right here, the stages of production.
Wait, I can't really see the triangle. Okay, there. It's literally just a triangle. Okay.
Yeah. Okay. So there will be. This is kind of a bad model, but you have little lines right there. They're called the stages of production. You have Q1, which is consumption goods, and these are the later stages of production. This goes up all the way to increasing production patterns, basically, through this. So when you have this right here, you see you need capital from the earlier stages to build on to the latter. So what happens is you take some resources from this area and take it down to the lower stages and increase. The issue is, without increasing savings, you cannot do this act because you have no capital to fall back on.
So I understand what you're saying, that you can't, produce endlessly, I guess, with nothing, really tangible to go back on. But I think that for the amount of, well, frankly, I think one, you're just going to see a lot of just inherent problems to having multiple different currencies. I don't think that that's optimal. There's a reason that I don't think that there are any developed nations anymore that operate under just multiple currency systems. I could be wrong on that. Are there?
Oh no, of course not. The state, it's hard. You can't tax it. So why would a state do that?
Yeah, well, yeah, that's that's part of the thing I was talking about before. I guess theoretically you could tax like two different.
I guess you could tax it
gold and silver. Theoretically, but I don't think that's optimal. I think that just in terms of just your everyday life, don't you think it would be better if like you knew that like every store you're going to is going to take your currency? Is that not like how you preferred to live?
It would of course work that way, because why would a company want to not take out value? Because we still have banks. Like looking about electric credit.
I'm talking about a system that has no. I mean, I think we're seeing some situations right now, like with Robinhood, they don't want to allow GameStop people to buy GameStop anymore. I think that corporations. Why wouldn't they let that happen? You know what I mean? That is a positive thing, but there are outside variables that can impact things.
I mean, the thing to say about that, I think the government's kind of tampering with Robinhood, especially the high investors.
No, how are they doing that?
The investors are literally paying the government to make sure they can't continuously invest in GameStop.
Rather than investors are just able to run everything without the government.
Yeah, that's again not really the debate.
Well, no, it is to a degree though. I'm saying because you said that why would I was just pointing out an example of why a entity wouldn't necessarily take your money. The Robinhood is literally not taking people's money right now to buy GameStop. I know that's a very specific.
Oh, okay, yeah. You're talking.
There are many things that you can point to of why maybe they don't take this currency. They don't like this bank. They don't like this bank. I mean, should you really be at fault if like the place you want to buy, Walmart doesn't like the bank that you use?
And then the issues of why they don't like banks, right, would be because of unstable currency, which under competition currency, where they would not really want that. They're going to keep it as stable as possible.
This sounds an awful lot like though the companies won't pollute because it's not like it's not profitable to pollute. I don't think that that's just how things manifest in the world though.
There's no reason why they wouldn't accept currencies, especially if they're inflationary. Then they won't, because it's not beneficial to them. But they're going to accept all currencies that are stable. This is again incentivizing stable currency.
You're saying that it's what is the range that's talking about for stable? I'm saying that if you put your money into a bank that makes some bad decisions, all of a sudden the currency that you use isn't valuable anymore.
Yeah, then you probably pull out of your reserves. It still has some value.
There are like real things that happen in between there and there. Like you go and maybe you can't afford groceries for a little bit because the currency that you want to use isn't good anymore. Like that's a problem.
So then, couldn't you say the same thing about the Fed? The Fed does the exact same thing. The currencies that we have right now could be hyperinflation, especially in the 70s. There was inflation on multitude of levels where you could not.
I think inflation was high like what, like 13% in the 70s. It was like really high.
It was up to 100% almost each 10 years. So it would rise 100%. The dollar would inflate almost $1 less value each 10 years. It was bad. I think it was 133% in 1970, and then it went up to like 200% in 1980. But these are issues. Like this amount of inflation occurs with the Fed. I don't see where as soon as we take away the Fed, it stops. No, I'm talking about there will be a lot more stability in currency with this, because again, the most stable currency will have the most amount of buyers. You're going to want to stay stable. And we can even I know you're like empirical data, right?
I would love. Do you have some data to support this?
Yeah, we look at, so we go to Scotland. I think they had it for 100 years.
What years were these though?
Let me just pull it up right quick.
Like
1716 and 1845.
Okay, can you like send it in the private chat?
If you I think there's just
just type in Scotland 17 or what?
Yeah, sure. I did this on my phone, and if I do it on my phone, then I'll lose the StreamYard. But
okay, that's fine. Let's see. I'm trying to look. It doesn't look like inflation was ever 100%.
It was 100%.
It looks like if we're talking about the 70s, the highest it was around. The thing I'm looking at says 1980. Looks like it was about like 13%. Just
no. It was I was talking over 10 years. So yeah, 13% over 10 years would definitely be over 100%. Each year it'd be 13.
It wasn't 10% every year. But regardless, that's what exactly is your. I was saying though, if you go to the store and they don't accept your currency, that never happened in 1980, in the 70s at all. There was no point where they wouldn't accept your currency anymore.
Like I don't see why they would have. That's money. They would have. They would still have value in it. Why wouldn't they accept it? They're hurting their own profits.
I think that there are. I understand that they'd be hurting their own profits, but I'm saying that you can think of examples where, if you don't have any sort of regulations or anything, why, large companies, maybe, you're saying that it would be geared by, profit. Maybe the large banks have, gotten in with the corporations where they're like, hey, we'll only accept, Walmart and, US Bank. They're like, hey, we'll take only US Bank dollars. We won't take anyone else's dollars. And then, your little startup bank that, you want to use because you want to, competition and whatnot, you want to use this bank, and now you can't use it at Walmart anymore. Like, don't you see that as a pretty realistic thing that could happen?
Yeah, but why would Walmart in any sense do this rationally? They want to increase profits, right? Why would they do this?
Do you think that what do you like price gouging and things, like entities working together to only use each other's things? Like, that is 100% something that happens. Oh, he left. I think we got him. I'm just kidding. I don't know. He left. I'll just mute myself.
He texted me. Let's see what he said. The fuck? Join back. Oh, he's back.
Just kicked me out for a second there.
What is up?
Okay, it just kicked me out. I don't know why.
But I'm saying, so what I was saying is, Walmart says we will take US Bank, Citibank, and Wells Fargo. We're only going to take these three currencies. So you're out of luck. How does that incentivize competition then? If the largest retailer won't take any currency besides the three largest banks.
So you're bringing up hypotheticals I think have absolutely zero base.
How does that have zero base? If the CEO of Walmart is given money because there's no regulations in this system from US Bank, maybe they give them some sort of kickback or something, and they say, hey, you're just going to take our dollars. It's like, sure, okay. And so now Walmart only accepts US Bank, Wells Fargo, Citibank. So now if you want to come with some other bank, I don't know, now you can't shop at Walmart anymore.
Yeah, but then this would internally hurt their profit margins because now an X amount of people.
That's the thing, though. That's not how corporations operate, like, necessarily. If you have the CEO, the guy that's making the executive decision.
Wait. So corporations don't operate off profit margin? They don't want to make as much profit as possible?
I think they do, but I don't think that they're quite as rational as you might want to believe. I don't think that they're.
I'm not saying that they're the most rational people. Of course, they make mistakes. I'm saying that making where you can't get as X amount of possibly up to like.
They know that US Bank, Wells Fargo, and Citibank are the three largest banks. I don't know if they are in real life. I don't think they are. But let's say
I get your point.
Yeah. So they know that 95% of people use those banks. And so, but how does that inhibit, or I would say that inhibits competition, because then the only people are going to go to those banks because maybe
then you have three banks that are even let's say that I don't think they're not going to want to take their profit margins like that. But
if they know that they don't have to use, there's just these smaller banks. This is how monopolies arise, and I think we can both agree that monopolies aren't good, right?
Monopolies are coercion, of course.
Oh my God. But once a company reaches like economies of scale, they can utilize things that a small company can't do, and so it's not good anymore. Like, it's just even that there is and this is like not even like a non-conventional thing. Like, monopolies are not good things.
No, I think certain monopolies can possibly be good, especially if they have competition with them and they're not basically using a government to lobby. But yeah, I get most of the things you're talking about where they have capabilities are like lobbying power.
No, it's not just lobbying power. You can have, Walmart does this. They can move into a small town and just undercut all the mom and pop stores, drive them out of business, and then they're the only shop left in town, and then they can pay employees whatever they want after that. This is something that happens.
Yeah, but they've also a lot of times minimum wage laws have helped them to do this, and they've also not.
It's not just minimum wage laws though. I'm saying that in terms of prices though, Walmart can sell goods for much cheaper than like mom and pop stores can. That's just a fact, and it's not because of minimum wage laws.
No, I'm saying that's one of the factors that could possibly hurt competition.
Okay, I always hear minimum wage. What is another? We can both agree that minimum wage is not the only reason Walmart is able to undercut.
Yeah, but I'm saying that they're also even then, you still have, but even then you still have Walmart can be efficient through this. If they're not efficient, of course you're going to have issues there. And then, again, I would like to stay on topic with this.
Well, no. I think it speaks to the broader system that you're advocating for. I think you showed me the graph of why you think that this investment would be good under this situation, but I think that there are problems that would arise because maybe in theoretically this interest rate that you're describing, but I think that there are larger problems that would arise from what you're advocating for.
So you'd say that recessions, like large-scale recessions due to monetary problems, are more favorable than having.
I think it would be an absolute disaster to not do anything during recessions.
No, I'm saying that monetary, like a lot of recessions are due to monetary reasons.
I think that a lot of recessions are due to lack of regulation.
So like 2009, so we'll say
that was due to the very debt crisis was because of the repeal of Glass-Steagall. So commercial banks and investment banks could commingle, and then they started trading a bunch of bad investments. The derivative market got out of control, and we saw that the entire world's economy crashed.
Yeah, again, you just said bad investments. They were overloaning, right?
Okay, due to lack of regulation, there was
yeah, but I'm talking about it went a lot deeper than just lack of regulation. Of course, you allow banks to go free, right? Okay, I'm possibly in the current climate.
Your solution though is that we should just let them fail and everybody loses everything.
No, I'm saying that banks would most likely not fail as much at all.
But wait, what basis is there for that? Like I said, before the Fed, there were bank runs. That's why the Fed came about.
Yeah, but their bank runs were not based around. They were based on sovereign currency. The Fed also
they had one currency that the banks were failing though.
Yeah, without competition currency, the Fed also manipulated. Not the Fed, sorry.
The bank run. It was in 1907, I think. There was a massive recession due to bank runs, and this is because banks were failing. This was not because, and it wasn't because everyone was using the same currency.
Wait, 1907, you said?
I believe it was 1907. Okay, I can try and look it up. U.S. recessions.
Panic or yeah, okay. Yeah, but that was also an extremely short recession.
1907. Let's see, is a 29% retraction in the economy. That's a pretty big deal. You can say it's short, but is it bigger than the ones around it?
Yeah, it lasted, from what I'm seeing, like 3 months.
What are you reading? This is 3 years.
Oh yeah, sorry.
Sorry, that's time since previous recession. Let's see.
So it looks like it from 2007 to like started getting back normal
over a year.
Yeah, it was almost a year, but we're seeing that we had recessions way longer than that before, and I'm saying that sure, crashes like that can still happen, and it's a lot more rare. Especially they didn't have complete competition currency either, but they still had the Fed.
More rare. There were recessions all the time. In 1902 there was a recession. 1899 there was a recession. 1896 there was a recession. 1893 there was a recession. What do you mean they were more rare?
Where are you reading this?
I looked up list of recessions in the United States.
Yeah, recessions can also be very manipulated in a sense. You can, over a certain amount of time downward, like going a downward trend, they consider that recession. So let's say you go from 100% in the economy, and then it goes down to 99 to 96, 97 over a certain period of time. That is considered a recession. Doesn't mean that.
What do you mean by 100% in the economy? How the recession is?
I was looking at this graph right here. I don't know why I said 100%, but it was you have a certain amount of outputs, and the output is still going the same, but it slowly reclines, and then eventually, over a certain period of time, you can still have recessions like that. But and then.
That's not what 1907 was.
Yeah, no, I'm saying
it wasn't just like an accounting, like way of measuring things in accounting. This was like
1907 was extremely short.
But I don't see how the time period is super relevant here when the people lost everything when their banks went under.
Yeah, so having free banking, right? We're going to.
We had a far less regulated banking system then. There was plenty of quote unquote competition between banks back then.
You did not have completely free banking. You still had regulation on banking.
As we get closer to that, like this is the thing. Like, what was inhibiting things back then? Don't say it was that they were using one currency. What was inhibiting the competition of the banks right then, where it was causing these banks to fail?
They didn't have naturally. They had government exchange reserve rates, which is another thing. You did not have reserve rates on
This is
people.
before the Fed.
What?
This is before the Fed.
Yes, you could. The government, even if you can see about wartime, like 1865, I think during the Civil War, we completely abandoned gold standards. Pretty much, we didn't have a Fed. We basically devalued and increased the fiduciary media in the gold, without having any amount of market demand for that. This was not completely free. Markets did not decide this. And again, I would rather you, I guess, attack my reasoning rather than just pointing out certain things that don't quite correlate, what I totally don't quite agree with. I don't see why.
Okay. Give me a line of reasoning you would like me to critique.
So I don't see why, if the most valued currency has the most amount of buyers, why they would not want to keep their currency stable.
There are all sorts of incentives that could lead to bad investment practices that would.
No. I'm saying stability in currency. Why would they not want to keep their currency stable?
Like if they want to put out a bunch of loans because they think that they can profit in the short.
Yeah, that'll kill them eventually, and then they'll fall out, and then they have to get their gold reserve.
Eventually, but this is what happens though. Banks go under; they make bad decisions.
Yeah. But you don't. For most bad decisions through banking are monetary phenomena, meaning they invest. You have the Federal Reserve, right? They gave around a lot of bad loaning systems. They inflated currency beyond belief, creating monetary disequilibrium, right? Then you have messed up pricing system, messed up loaning systems. You have lower capital value because capital value is based around good interest rates and outputs. Outputs worsen because you do not have good investment. Without these investment practices and good safe investment practices, which is based around currency.
I think when you only want to look at this, dude, like these little line of reasoning that you decided, but you won't accept outside things. Like if you want me to critique the logic of it, I brought up that there are plenty of reasons why a bank would not necessarily use the best practices, and we know from like history, corporations and banks are not always the most rational people. Yes, they are incentivized by profit, but people don't always make the best decisions.
And I've never said it, but I'm saying you have a lot stabler than our current system. Our current system has zero incentive.
Well, when was the last time someone lost everything due to a bank going under?
It's not just banks going under. We're talking about.
That's what I'm talking about, though. You said we have a more stable system. That doesn't happen anymore.
Yeah, but we still have lots of recessions caused by monetary phenomenon, and this is when
I understand we still have recessions, and you need government to lessen the problems with those recessions. You don't need to just do nothing and just say, "Oh well, hopefully, if we have a bunch of currencies that'll."
I'm saying that the monetary policy of the Federal Reserve is causing these recessions in the first place.
No, it's not though. It's objectively not. It was not monetary policy that caused what happened in 2008.
I'm telling you, you had the capital, right? Capital value decreased in 2009 or 2008. Sorry, not 2009. During 2008, right? You had very low interest rates preceding this. The low interest rates preceding this caused lots and lots of malinvestment. These low interest rates were, of course, derivative of these bank systems.
Wait. Well, what is stopping there being from low interest rates in this free market system that you're referring to, where people
low interest. I'm talking non-natural interest rates. You can still have these interest rates.
It's never going to be at the interest rate that you're advocating, because it's never going to be perfectly at equilibrium. Like even everything's going to be at equilibrium.
I'm very disequilibrialized, but because any little change, like let's say someone sneezes on a gold coin and has to throw it out, it's considered monetary disequilibrium. But you still have a lot more stable currency and interest rates. Interest rates have to be derivative of market phenomenon. It has to be through exchange ratios.
Why?
Because the banks, if they continuously do this practices, they're going to lose out like they did in 2009. Because
it wasn't because of the interest rates, though.
Interest rates caused malinvestment in 2009.
Eventually, banks were incentivized because, like, is your argument that you think that because the banks knew that they would be bailed out, that they were doing these bad investments?
Yeah, they got bailed out, and they also had a lot of inflation, and they also didn't have, they didn't quite understand returns. I think I'll go back to the first equation I showed you today. Yeah, let me find it.
I don't necessarily want an equation. Okay.
No, well, I mean, economics is based on a lot of mathematical.
It is, but I think it needs to be based in data. I think it needs to. We need to have a foundation in data. I think that I think that I know that Austrians really like praxeology, but I think you got to have empirical data to support what we're talking about.
I can show, like the interest rates during this time were definitely not around this area.
But what makes you think that interest rates would be where you want them to be prior to this?
It's not where I want them to be. It's where market demand wants them to be.
What makes you think that the interest rates would be where the market demands wants to be? Because it doesn't. It's the market demand. Like what is this? What are you saying?
Demand for holding. As holding increases.
But if it's the corporations that are lobbying the government for the interest rates to be at where they are, what makes you think that that's not just where interest rates would be if there wasn't government?
Then banks will go under if they do not stay.
And banks did go under.
Yeah, but that's the issue. Banks do not want to go under like this under a free market system. Not in their best interest.
Something that happens. I understand. It's not in anyone's best interest to go under. It's still not in the bank's best interest to go under. It's never in any company's best interest to go under. That doesn't mean it doesn't happen, though.
Yeah, I don't know, but you're saying that. I'm not saying it'll never happen. I'm saying that it'll happen
all the time. It happens all the time, though.
Yeah, a system that's happened once, right? This kind of system's happened once, and it did not happen in Scotland. I don't. This is.
Frankly, I don't think that Scotland had necessarily the sophisticated economy that we have today. Like, I mean, what exactly did you want me to look up before about Scotland?
Here, I think Austria. Hey, just look up. Where did he have it? Okay, the Bank of Scotland. Oh, never mind. What's his? What did he linked something in this chat? I can't find it though.
Oh, it's in the chat?
I thought it was.
The Lawrence White's Free Banking in Britain book?
Yeah, something like that. And I don't think you've even somewhat addressed my my first original claim is that low interest rates and monetary disequilibrium cause recessions.
That's not what's causing the recessions.
No.
I'm sorry. It was putting in a bunch of the. We can talk about 2008. It was not because interest rates were low that these people so you're saying what if interest rates had been 3% higher, they wouldn't have been.
No, natural rate. It's not exactly an arbitrary number. It could possibly only whatever percent higher, but it's still they were artificial. The interest rates during basically before were close to 0% preceding this, and then we can just go on through 2016. They were pretty the federal funds rate was basically at 0% through after the recessions. During 2002, they were
recession when all the bad investments were taken. What was the interest rate then? What should it have been?
Wait, what year? What year did you say?
Prior to the recession. You're saying during the recession.
So 2002, we're under 2%, and then we increasingly around 1%. Until I think they realized that they went too far, and then they rose it back up.
Just a more democratic Fed that is more accountable to the people. If we get rid of money in politics, where it's not corporations and banks setting the interest rates, it's politicians that have the best interest of the people setting the interest rates. What is making us think that then maybe the rates wouldn't have been just?
They don't have market signals ever. They do not have market signals everyday interactions with everyday investment.
Do politicians like live in a box where like they don't have access to like the outside world? What do you mean they don't have market signals?
They don't have competition. Competition is one of the most important things.
Do politicians not run against other people to become elected?
Yeah, they're not, but it's not. It's the Fed is completely different. They run off based on.
I'm arguing for a more democratic Fed. I am not arguing for the Fed in this current manifestation. I think the Fed is not. Has done a lot of things.
A more democratic Fed.
Or not in recent months, we've seen very bad practices from the Fed. I'm not arguing the Fed in its current practice, but I'm saying what you're advocating for would be substantially worse.
So you want a democratic, and again, you need competition to understand markets because you have no incentive, literally zero incentive, to be better than the other, to be a better bank.
There's no way that you actually believe that. There's no way that you believe that if the Fed has no incentive to do a good job, like is that there's no incentive?
No. They don't have a very good incentive to keep a stable currency.
Why? What? How is there not an incentive for that?
It's literally so if governments expand.
Literally, if just the people working at the Fed use the currency, then they themselves have an incentive to keep the currency stable. This is unreal. The idea that just because it's not this like a free market utopia, that there isn't like incentive for currency to stay stable.
I'm saying that it's a lot harder for them to stay stable. They don't have the same incentive as competition currencies have. They've had far less incentives.
How do they not have an incentive? Do you not
No,
want?
no.
Do you, as an individual, not want your currency to go up 50% in the next 2 months?
All right, that is not the best wording, but I'm saying they have less of an incentive as competition.
Why?
Because competition, if they do not keep stable currencies, they go.
Without just saying competition is better. Why?
If you have competition.
No. Without using the word competition, tell me why it's better.
Saying the phrase, you just cut me off before I even spoke. When you have this blank, you have these people. They do not want their currency to go under, so they're going to try to keep it stable around market.
Wait, we can agree that people right now don't want the currency to go under.
Yeah, but you have other banks to make sure that this does not happen. You have basically margins of how people react through certain banking systems. You have the way people go through financial investments. We want the most valued currency, so you're going to want to keep it stable as possible. Right now, the Fed does not do this. Historically, has never done this.
I know that the Fed doesn't do a good job. I'm not defending what the Fed currently does, but I'm saying with a central banking system, not in theory, why do they have no incentive?
I said I said this after I said.
Why do they have less incentive? Why do they have less incentive?
Because they do not have competition to figure out certain things.
What information do they not have access to?
It's not they don't have access to the information. They do not have the same.
What don't they have access to then?
What do you say?
What don't they have access to then?
I said they have access. They just do not have the same. I guess not ideology. What the hell am I saying?
Are the constituents that are voting these elected officials in, are these not the same people that you are relying on that will set these perfect interest rates through a free market system?
No. Sorry, can you repeat that?
Well, how will you not also, because like what you're saying right now is that the Fed is setting these bad rates. I'm saying that right now the Fed is currently basically bought by the big banks, by corporations. And so how is then giving the power to the banks and corporations going to make the interest rates better?
Because if one bank decides to inflate or bail out, it's going to go under. That is what they're trying to avoid.
Oh, that's not a good thing, though.
This happens in our current Fed. Banks can still go under. They bail out.
We lose everything. We have FDIC insurance. You were insured. And
you don't lose everything in this system either. You still have your gold that you are whatever reserve commodity you have.
Not in your ideal system, because you're advocating for an anarchist system, but in the minarchy society that you're advocating for, that hopefully you will have signed a contract beforehand that the bank will keep a certain amount of gold on hand to pay you back. That is what you're banking on. No pun intended.
Yeah, that's you have reserve rates.
You have reserve rates, but they're not set by anybody. They're just set because because right now the Fed can say that you have to keep a certain amount of money on hand. You have to have I forgot the term.
Contractual agreement.
Yes, through contractual agreement. That's right. But you're not advocating for a system that where you have to enter a system that what if a bank says you can say it's through contractual agreement. What if a bank says we don't have to keep this much gold on hand?
Then they violated contracts. So
no. I'm saying if that's not part of the contract,
then no one signs that contract on the bank.
No one will sign a contract.
If that's not what people want, no. And you would still have your money coming back out of so if the bank fails, they have to give you money back. That's how it's worked through history. It's bailouts that hurt.
Except for when banks used to fail and people would not get their money back.
Because they didn't have the government did not upheld contracts.
Was the government stopping them? Was the government stopping them from giving them their money back?
No, but they didn't do anything to make sure they got their money back.
Exactly. So we need the government to do that.
Yeah, I even said this in the beginning of the debate. I'm pretending I'm in a minarchist society.
Why not advocate for what you're actually advocating for?
What?
Why pretend? Why not advocate for what you actually?
I don't want to get into an anarchy debate.
Okay,
that's what we're into.
But I'm saying though, the government is not forced. So when you go to the bank, the government is not making sure that you sign a good contract. You're saying that they will enforce contracts, but no one is making sure that it's a good contract.
Yes, they said
all the bank will stay. All your money will stay in the bank.
I'm saying that the issues of the old banking systems is they did not give their reserves back. The government did not protect this right of contractual agreement. So when they had this agreement to give the reserves back to the people, they did not do it.
But people still aren't getting all of their money. And I don't think
that's the issue. They never did. That's why the government was inefficient at doing this.
But what makes you think that the free market would be better at doing that?
Again, I said, if we're talking about just rights enforcement in general, the government would have to.
I feel like there's a separation of what I understand that you're saying that the government will enforce contracts. I'm saying though that you're saying that in this free market system that the people will be entering into good contracts. That's my problem, is that people aren't going to necessarily be entering into good contracts.
They want to enter into good contracts.
The contracts that exist, but that doesn't mean people are going to be entering good contracts.
But why wouldn't they want to?
What do you mean? Why wouldn't they want to?
Why wouldn't people enter good contracts?
Consumers have perfect information where they can know every single thing when they get into it. Are we all, is the average person a banking expert where they know that it's better to have this much reserves, where instead maybe they think they can get
no, but they're not going to want to, especially if a bank is being predatory. They're definitely not going to sign with them if they
people have never fallen prey to predatory banking.
What?
Because people have never fallen prey to predatory.
Yeah, I'm not saying that. I'm saying that they fell victim to predatory banking, and then the banks got bailed out, so there was no history lesson taught. Well,
frankly, what should have happened is when we bailed out the banks, we should have, as the people, as the taxpayer, we should have got an equity stake in those banks, where there's a good argument to nationalize them. But I think that's a different thing. That's not. You completely separated from what I was saying though by saying that because the banks get bailed out. That's not what we're talking about at all.
No, I'm saying that when you have these practices, eventually people will learn certain things.
Okay, but so what has to happen though for people to learn these things? People lose everything?
Yeah, but what's the same thing? I'm saying that currently we have recessions that
cause... Nobody loses everything now. That's not what happens anymore. Now there are other situations where people can lose anything, but you do not lose
things like losing their job, things like losing their home, losing a lot of their liquid assets.
I'm all for guaranteeing housing as a right to people. I think that's the direction we were going, but I am all for guaranteeing housing as a right.
But so you want recessions to basically just have housing and then just basically back it up with housing. Just have recessions
to be backed up with housing. Could you elaborate?
Yeah, so like you're saying, so now that we have these recessions, of course they're going to have an economic downturn, which I think, unless you're saying that you could possibly do this better.
I think if we had regulated the banks better, if we hadn't repealed Glass-Steagall, the recession wouldn't have been as bad as it was, because you wouldn't have had commercial banks and investment banks working together.
Yeah, I'm saying Glass-Steagall during that time frame possibly would not have been the best thing to do, but I think of definitely very different reasons than you have. The interest rates were extremely low during the time, and then you had basically deregulated banking, allowing these banking systems to basically expand, and then they knew they're going to get basically money back from the government. That was the issue there. And I don't think we really disagree.
There was no really precedent for what happened necessarily to say that like they knew that would happen. But I'm saying though that not necessarily that you need to bail out the banks. I have no interest in making sure that Wells Fargo necessarily says, well, but it's the people that I'm saying. It's the people that need to make sure that they have the money. That when you put your money into a bank, you need to have some sort of insurance that you will get that money back.
So I'm saying you get the money back through the contractual agreement that is withheld.
No, I'm saying that what is preventing you from entering an agreement where it's not a good agreement, where you will get potentially 10% back or maybe nothing back.
But that's your idea, and you must trust that bank that much if you're willing to go into that. That is your voluntary decision.
Okay, so someone is foolish and does that. Do they? Is that so they're out of luck, I guess?
But here's what I think you're also another thing you're missing is that sure you can enter bad contracts, right? We're currently forced into a bad contract.
Could you elaborate?
Yeah, so the Federal Reserve, we have 0% return rates. Let's say certain.
No. You can't keep saying that. Nobody loses all their money if a bank goes under anymore. You can't keep saying that. That's what we have right now. That's not what we have right now.
People do lose lots of money during recessions. That's what I'm saying.
People lose lots of money for a recession. I'm specifically talking about if a bank fails. I'm all for better handling how we do recessions in the country. I'm all for that. But if a bank fails, you don't lose all your money anymore.
You lose a lot of liquid assets, or you have companies that lose lots.
If you go and put $1,000 in a bank and that bank goes under, you're still going to get your $1,000 back.
Yeah, but the $1,000 could possibly be now inflated to whatever, or that.
It's your argument because there might be like 5% inflation. That means that's equivalent to not getting anything back.
But I'm saying these things. First off, I don't think these things happen on a large scale.
They did. I'm sorry, but they did. Banks used to go under and people would lose everything.
I'm just curious, why didn't this happen in Scotland?
Why didn't it? I have no idea. You can't even tell me what to Google in Scotland besides a 100-year period.
I told you, the free banking in Scotland.
Free banking in
multiple times.
Okay, let's take a look. Why didn't this happen in Scotland?
3 or 4 times.
Banking in Scotland. Scottish free banking last she 70s is arguably one of the most research and developing instances of free banking. The system was organized 3 chartered banks, Bank of Scotland, Royal Bank of Scotland, and the British Linen Company. Let's see. This is organized 3 chartered banks. Banking system. All right. Let's see here. Do you want to keep going while I'm taking a look at this? It's just like a 2-sentence thing.
Yeah. It's gotten so far off topic.
Okay, well, bring us back to the topic then. What do you want to?
Okay. Did you say anything to my equations that I threw at you, or
Say the equation again. I'll introduce a separate variable or something. What's the equation?
So you have Q, which is linear outputs, is equal to UN.
Let me get a piece of paper. Okay. We got Q.
And just put up this list of variables. Q equals a combination of outputs.
Okay.
So basically, that's basically production. And then you have N, which is equal to labor.
Okay.
And then you have R, which is equal to basically interest rates.
Equals interest rates. Okay.
And then so here, Q is equal to Qn plus Qn.
Q equals Qn plus Qn. Okay. You say Qn plus Qn.
Yep. It's
okay.
Different stages of production. Minus 1R.
Minus 1R. Okay.
Plus Qn minus 2.
Okay. Plus Qn minus.
And then another R, and then R squared.
And just like plus or minus or.
No, just it's a multiplication of the.
Okay. There we go. Okay. R, and then another R squared.
So Q just R squared. After the N minus 2, it's R squared.
Okay, R squared. Okay, I think we got it.
So outputs, which is Q, times labor, which is labor productivity basically, plus Q, and then you have N, which is another labor, and then you have the first QN is basically consumption goods, basically retail. Then you have wholesale minus 1R, which is the second state of production. The second state of production is, again, contingent on interest rates. So if interest rates are supposed to be lower, meaning they have higher value, when you have this interest rate at a artificially low value, you are basically telling these investors that they have enough to go into the second state of production, which is Qn minus 2, or Qn minus second state of production, which is now we are on the third stage of production. This is basically expanding into higher set of goods. Then you have R, which is another rate of interest. This interest rate is again for the next stages and so on and so forth. This interest rate is always contingent, and if it's not based on market values and is artificially low, you are telling businesses that they cannot, they are able to expand without actually having any capital to expand upon, because Q is not actually increasing when it's artificially low.
Okay, so this equation is based on Scotland?
No, this equation is. I said this is back to the main topic. I was arguing for Austrian business cycle theory, just saying that basically that.
Like, why does this equation matter? Like besides like.
This is like when you have these interest rates low, you're expanding without capital. Not just low, based around actual productive output. So Q is still relatively low here when we're talking about 2000. Let's say 2009. I'll just say the Great Depression. Q was relatively low, yet we were expanding exponentially because our interest rates during that time were extremely low. We had the false signals of saying, we had false signals telling people to expand, except we didn't have actual capital to expand upon. So this is what I'm saying. When you have these low interest rates,
the lack of capital, is you're saying there wasn't enough like gold to back up like the money that people
capital is basically all production. It's basically capital is a production plan. So you have things in this plan such as the paper bag is considered capital. Things that help it during production.
So, a paper bag is considered capital. So like the means of production, for lack of a better word, like that's what you're talking about.
Yes, yeah. So materials, things of that nature. We didn't have, yeah. So we were telling people to expand without actual increasing output.
So because you had low interest rates, you're saying you were incentivizing.
You're incentivized because to make returns, you need to increase returns on investments. You need to increase Q while R is relatively low. The
Why?
issue is what?
Why?
Because Q is capital value, so capital value is increasing, right? R is the rate of return.
I'm trying to make this, I want this to be more, real, pragmatic. And so I'm saying, so Q, without just saying that Q has to increase because of R, like, could you in real terms?
Okay, so output is increasing. This is why you need to have these things contingent upon each other. Output is increasing, capital is increasing, yet R is lowered, so you're having higher return rate because you have more. The interest rate is low, so the funds you got to invest in that higher capital, the capital that was supposed to be there, demanded by people, was increasing. So you make high returns rates. Basically, you can have enough savings to go into the second stage of production. The issue is demand was not quite the same, so Q was lower. You didn't have as much returns.
People were producing past demand, is what you're saying.
Essentially, in certain past resources, past demand, demand for consumption goods, production goods.
And you're saying that this can't be remedied by, say, if we had just set interest rates higher.
Well, it's not as high. Because if you set them too high, you have similar issues. You have Q is rising exponentially, but the interest rate is so high, you can't make the same amount of returns.
But to be fair, you are literally saying, though, that the way that the market would decide this is by it would be too low, and then these negative things that you're referring to would happen, and then it would go too high, and then the negative things you're referring to would happen. And because not everyone's like using this equation. Like that's what you're saying, though, is that like it would be too low. So like this would happen in both.
No, I'm saying these things are figured out through free banking systems. You have an interest rate set around investable demands. The bank doesn't want to lose, neither does the consumer. Not saying malinvestment is never going to happen, but I'm saying it's going to happen a lot less likely because you have a stable currency and you have interest rates that both people want to benefit on. Right now, the Fed prints sometimes literally to just pay off debt or to pay off certain policies, or we have interest rates really low to try to stimulate demand. These things inherently have been throughout the Fed's existence.
Okay, I understand that the Fed will try to print money to pay for different spending. For example, I think that a lot of times that spending can be good. I think that the negative ramifications of printing to spend are a lot less than the positives of the spending.
So you think printing is good?
I think that not like in a vacuum. I think that printing can be good.
I would say then you have a different issue there. Then you have a price issue. Prices are then based around monetary disequilibrium. You have prices that are not reflecting. I'm sure you've heard of the productivity to wage gap, right?
Yes, I've heard of that before.
Yeah, so we can see this is due because during the same time of this productivity wage gap, the Federal Reserve and high inflation happened after this. Basically, people didn't understand that we had a higher inflated dollar each year, and then we saw that companies
in a system that has no regulations or anything, that people would understand that better.
I would say, well, no, stable currency. That's all I'm advocating for is stable currency.
It's stable, not stable currency. You're advocating for multiple different currencies. For banking.
Yes, I would say this is the stablest currency you could possibly get.
It's one stable currency, though. You want multiple currencies.
I don't think one possibly once. I'm saying that I don't think a Federal Reserve has ever. I'd love for you to bring out, since you've grilled me on empirical data. I'd love to see a Federal Reserve have stable currency.
Well, how are you defining stable currency?
Creeping inflation.
You say keeping inflation?
Creeping, very low inflation.
Okay, what is your number for creeping inflation?
Here, we'll just look at this.
I think Switzerland has very low inflation, to my understanding.
I would like to see graphs. I don't think I could.
Hey, let's see. Inflation in Switzerland. There's a 0.36%, 0.94%,
So inflation in Switzerland has from 1974 up to 10% inflation, back down, and then they increasingly bring it up and down, up and down, up and down. I will show you the graph right here. This is also not good because then you have deflated currency.
Wait, what do you? Wait, how are you showing me? What are you showing me? Okay, there it is.
Is it focusing?
Yeah. So what's I can't see what the top what's on the y-axis? What's the top number?
11%, and then it's through the years. So we have this pattern right here. It's not very stable.
It looks like it's pretty stable there at the end, frankly.
Towards the end, yeah, but then we had sharp crash, even deflation. A lot of times they've gone down, and this is another thing we've seen. I don't want that kind of currency either. This is the Fed. It's incompetent. We see this type of issues where the Fed has never, ever, I don't think has ever had stable currency. This currency is not very stable. It's moved up to 10%, then it brings back down to 2%. This is very drastic changes in currency.
That's the only thing that you care about, though, is how the less inflation. That's
less inflation, just stable currency and stable interest rates.
And you think that those are the two primary things? Like you don't think that other like I don't want to strawman you, but like that's like all the other things that I was talking about. Like banks going under, people losing everything.
I would say that these practices.
Like, for example, if there are say a bunch of people that don't have healthcare, and so instead of spending to make sure that everybody has healthcare, we don't. Currency stable, a bunch of people die because they don't have healthcare. We're weighing our options. What do we think might be better?
I'd say that's very off topic, but
no. I don't think it is, though, because if you just want to talk about inflation, you can say yes, in this theoretical world where it's where we don't necessarily have any data that we can look at. Besides Scotland in the 1700s, where you can say that a stable currency would be better, but without looking at any other factors, I think that if it's slightly more inflation, but everybody has healthcare, I'd say that's a good trade-off. What would you say?
I would disagree. I think a free market can give healthcare.
But I don't. It doesn't. We know that as of right now, the free market at no point has everybody had healthcare. There's without some sort of government intervention.
Yeah, I don't think. Yeah, I would. Again, it's a theoretical thing I'm claiming here. I would say that I don't think this is needed. Healthcare debate needed, but
if we're going to talk about spending, I'm just saying, insert whatever you want instead of healthcare. Spending on X.
I don't believe the government
X can be better potentially with slightly more inflation than 2% inflation. If you have 5% inflation instead of 2% inflation, but everybody has this X that we're spending on, I'd say that's probably a good trade-off.
No, I would disagree with that. Saying that having monetary equilibrium is terrible for wages. It's terrible for stable production. It's terrible for increasing capital output of capital value. Sorry, capital.
Let's go one at a time. So it's bad for wages. So you're saying because there's inflation, your wages potentially aren't going up with inflation. That's what you're saying. Okay, and then so you don't think that potentially if we have high rates of unionization, more collective bargaining, you don't think that can get better wages?
We had higher rates of bargaining in 1970s, and we still had one of.
Well, we want the 50s, 60s. I think that we had much better rates of unionization, and I think we had a lot of things going on in the 70s that
they also had a lot lower rates of inflation during that time. But again, I would like to say, the main thing I'd probably go is the third point of capital value. Capital value is one of the number one.
It feels like every time I bring up a thing that is like a problem with what you're saying you want to stay on topic, but like your only topic is this equation, and if I don't say this equation is correct, then I'm getting off of topic. That's what it feels like.
No. I was saying that I could see certain things where I thought they might be going. Like I didn't want to make minimum wage debate or healthcare debate. If that makes sense. Or like that's why I said I was a minarchist at the start. I didn't want to get into like rights enforcement agencies or anything like that.
Okay.
I wanted to stay on monetary policy.
Okay. So, but we can't talk about banks going under. So that's not.
I never said banks.
You think?
I said that, I said it was inconsistent or disingenuous to say that something I did not advocate for and the issues with that system was basically valid. I say it's disingenuous to say that something I advocate for, I would have to fall suffrage to.
Wait, it's disingenuous that I said that.
Yeah,
because you're advocating for no Fed, that it's disingenuous to say that banks would fail.
No. I see, because you said that during the 1907s or 1907. Sorry, I don't know why I said 1907s. 1907, that the bank system was flawed. Well, I'm not advocating for the bank system. I think the flaws in that system were due to lack of competition in currency. But again, I don't want to make bad blood there.
It wasn't because interest rates were high enough that the bank runs were happening in 1907, though. That's also not why what happened in 2008. Like, can you show me something like what were you saying that, like, if interest rates had been like slightly higher, that like is there anything that you're pointing to that says that like we could have averted like what was happening in 2008? Because I know you're saying that like not necessarily higher, just natural, but natural would be higher. So I'm saying, like, can you point to something that would like?
Yeah, the equations I've showed you are explaining that production processes with low interest rates or artificially low interest rates cause false senses of production increases. So production increases in the housing market. We saw the housing market. I think we can both agree. It was in 2008. It was very easy to get a loan. Correct?
Yes.
The interest rates were extremely low.
Yeah.
These interest rates for production plans were extremely low, yet the output and demand for these things were not high. So this is what I'm talking about. The interest rates were not they were not good interest rates. They were very low. They were not based around actual capital. Capital was
I'm saying if we didn't have this regulatory capture that we currently have, where corporations have effectively bought the regulations in this country, I see no reason to think why we wouldn't have had interest rates that are much less advantageous to people just lending willy-nilly and then hoping that they'd be bailed out.
Well, sorry, I lost something. Okay, sorry. I was trying to get my water bottle. I lost that. But we have the issue. The Federal Reserve. I think that was you saying the Fed could do that. The Fed could make stable interest rates.
I say that 100% could make more stable interest rates than they were right then. I don't think that if we want to talk about like the difference between like the reality and like what system we're advocating for, the system I'm advocating for wouldn't have had the regulations bought by corporations. That's.
And how do you propose to escape this?
I would think that we should have restructure our campaign finance laws, where big money interest corporations aren't allowed to donate to politicians in the way that they currently are, frankly, at all.
And when half of Congress is being bought off, how does that work?
If we don't allow corporations and politicians or big money interests to donate to politicians,
but how are we going to do that when the act that would cause that the act of causal relation?
Wait. Are we going to talk about which system is more realistic now?
No, I'm just saying that.
The 22nd state today to support a constitutional amendment to overturn Citizens United. So we want to talk about realistic. I got 22 states that are in favor of overturning Citizens United. Which state has signed on to get rid of the Fed? If we're going to talk about like which system is more realistic.
Yeah, I'm saying that a lot of people will not do that. But I get. I was probably going off topic there too. Yeah, I do not believe that the Fed will ever do that. But I also do not believe that even then you would still need competition currency to do.
Wait, I'm really confused. How on earth can you be appealing to pragmatism now?
What?
How are you appealing to like whether or not?
I said that was my mistake. I shouldn't have done it. I said yeah.
All right. Well, okay, fair enough. But like, what is your, I guess, rebuttal to that then?
To pragmatism?
No. Your rebuttal to what I'm saying, that if we didn't have a state that was bought off by corporations,
they do not have competition in currency. And
okay, but because there's not competition in currency, that is like the source of all problems.
The
source of all monetary problems.
Now, there's multiple different schools of thought on how to fix this. The Chicago schools basically just thought of basically barely inflate the currency or keep interest rates basically very stable or attempt to basically keep them the same. But I'm saying that still has flaws because the market demand is not met based around how people view things.
Do you think that there are a lot of people itching to have multiple currencies?
What?
If we're talking about demand, like, do you think that that's like something people demand? Is like people want multiple currencies?
No, and most people probably don't even know what it is because I don't think many people read Hayek. But
Okay.
what?
So I mean, if we're saying like demand, I think that people would demand.
No, I'm saying in the society of free banking system.
Okay. But like, I guess this is like, but naturally, I mean, we assume that one currency would probably eventually win out, and then that's the currency that everybody would use, right?
No, I would think that multiple currencies. It'd be very hard to be the top dog for very long.
Why?
Because again, we said that people make mistakes in banking systems. One could possibly fluctuate.
It wouldn't be in their interest to fail, and so it would happen very rarely. Now you're saying that you would never have like a single currency or like a few top currencies because they would all fail so often.
No. They'd fail less, but it's not saying it's impossible for them to fail. And also certain fluctuations, not necessarily failure, but basically just they not showing market demands with inflation or interest rates the same as other bank systems are.
Oh, wait, okay. So now this is interesting though. So now you're saying though that like we get to like where there's two currencies, and I said like, don't you think it would eventually just blend into one? And you're saying that you think one of those currencies will fail, right? And that's why it won't.
No, I didn't say fail. I said possibly just be less efficient than the other.
Okay.
So
Okay. It'll be less efficient, and so then people would eventually go to the.
It will definitely fluctuate based
And then
on.
we have like a monopoly, like a single bank, right?
I don't believe a monopoly is very pragmatic in this system. I think most. Number one really matter. There would definitely be more than three at a time competing with each other, just be based off how they probably view things fluctuates. You have one banking system try to give its certain rate of inflation what they think money demand is, but the other person does it slightly better, that would go to them, and then et cetera, just fluctuate. But it doesn't mean they're going to completely all fail.
So you're saying like people will like switch back and forth between like the top three?
Yeah, it could possibly do that. Yes. You have certain people have multiple credit cards. Certain people have.
People have multiple credit cards, but they know that it's all using the same currency.
Yeah, but I'm saying that you have banks certainly. So like Chase Bank could have a certain currency, and then their reserve ratio is based off a certain value system. The value system is based off money demand.
Okay. We've been going for quite a while. I think.
Yep.
Is there any last things you want to talk about?
Nope, I'm pretty much. That's about all I. That was that.
All right, cool. All right, well, I'm sure you guys will do some sort of post stream something or whatever. But yeah, it was a good time.
Yep. Thanks for coming on.
All right, you guys. Oh yeah. All right, you guys have a good one.
All right, you too.
Right. Oh my god.
I wanted to hang myself.
I wanted to come in there. You should have brought up the state's during the time, like, oh, how can the state do this? The state cannot like actually see like real market exchanges in regards to like, time preference rate and savings and consumption.
Yeah, I said that, and he basically said, why not? And I'm like,
the monopoly. There's no competition. What happens in a Fed is they have like some sort of like arbitrary way of setting their own like interest and like.
I don't know.
Which causes like inevitable like misallocated like the inability to see market signals to adjust to like actual natural rates of interest and time preference.
I don't think he understood the relevancy of my equation, and that probably was wrong.
You should press him on the deregulation thing.
What?
You should press him on the deregulation. Because he did not substantiate anything in regards to deregulation.
Yeah, and I was just.
No,
I told him like
it was just in regards to 2008. Yeah, it was deregulation with the repeals of glass deals, but it was deregulation backed by central banking. So
I literally told him that. And he's like, I told him, I told him, you have the banking systems and the interest rates during this time were exponentially low, causing malinvestment. So of course, having free banking systems with shit currency is going to cause this. And he basically just laughed. And then when I try to bring up capital value equations,
you definitely won that.
When I try to bring up capital value equations, I don't think he understood them. And I think that was the issue. I tried to explain, but he didn't understand the relevancy. If you have shitty interest rates, you're not going to do it.
Justifying those equations.
What?
You need to justify the truth of those equations.
I did.
I'm That's because you're saying, oh, but this is like what happened. This is what happened.
Well, he didn't have any contentions with them. It's hard to justify.
So you even have like a certain like way of like establishing like why this happens from like a place of like human action or like something like that. So you can't just say a random equation.
Well, no, I was kind of hoping he would have an issue with one of my equations, but he.
That's not how it works. You prove your equation first.
Yeah.
You need some kind of like backing to it, like a methodology.
Yeah, I probably should have said that. Well, it's kind of a straightforward input-output equation.
Sure, but then again, you still have to like substantiate advantages because there's different equations and different.
I don't really know how I could devalidate the truth. This is basically the simple stages of.
Say it's like a deduction of Austrian economics based on praxeology. That's how we arrive at these conclusions.
I think it's Hicks's equation. Like most of Lewin's equation are based on Hicks, which Hicks was a neo-Keynesian. So, yeah. Compbot was in here. Wow.
Some people were in here.
Well, I guess I was okay. I just wanted to have like one monetary debate before like West. West is going to be a while. So. Life hacks with Pop.
That's me. You said a account I'd post life hacks.
What?
I have an account I'd post life hacks.
Well, time to do a history map.
Do you like
the new Avatar?
Yeah. Read the theory of free. Read Free Banking in Britain by Lawrence White.
Yeah, I didn't have any. I wasn't expecting to actually need empirical data. I should have probably figured that. But
you did really well, and you definitely won that by far.
I wasn't thinking about win or loss. I just don't think. I definitely probably should have mentioned Scotland a lot earlier. I feel like I was trying to think of like the best way to like put it, and then it just kind of came to me way late. I think actually I read
drawing some complete false equivalencies to the Fed versus non-Fed. So he was trying to say that. He was trying to say that like in regards to like the Federal Reserve in terms of like failing banks and stuff. The thing is, he was comparing a free bank. He was trying to draw an equivalency between America's system before the Fed to free banking.
And I told him that I was like, again, we had reserve rates back then, but a lot of times they were abandoned.
You said Fed bad. He's like, oh, but before Fed failing banks. That wasn't free bank. That wasn't your system that you advocate for.
And then I'm like, oh, this is the funny part. It's like, well, what happens if it fails?
In America, government was setting fixed exchange ratios for like the actual value of money. It wasn't like a market, like a actual market, like prices to work on different things, which is what caused the problems.
And then when he said free banking, what happens? Well, won't people lose all of their money if a bank goes under? And I'm like, no, you get returns back. The issue was before this, the government didn't give you returns back. The government basically said, fuck you. Here's $0 back when your bank fails. And I told him when our bank fails, the Federal Reserve right now, we either bail out big corps, right, big banks, and you lose your job, which happens a lot. You have like up to 30% unemployment. It's been one of the highest recorded. I don't see how that's not losing everything, but when you get 70% of your reserves back, it is. It's like, and then I don't think he ever brought up like there'd be less inflations to begin with, and then he said, I'm fine with certain inflations if we have certain like policies to mitigate. Like,
how can you mitigate it? You can't measure supply and demand properly. You're a monopolist. You can't see a real like market. You can't see the same thing that you can see in a market.
I was like after he started ignoring shit, I just kind of not gave up, but I just kind of stopped even looking at my notes because I knew it wasn't going to matter. But I'm just basically prepping for. I think I'm debating West like in June, so West is probably going to kick my shit low key, but. Doesn't CPI's got Compbot. If you're still here, Biden was on. Biden wanted to hire a person that wanted 0% interest rates.
Bro, how the fuck did this debate go from like a debate on the Fed to like other things?
I don't, because this is he. I don't think he even mentioned that. Like I brought up my first point, and then he just kind of thought like, "What do
You
you?"
said, oh, what's your ideal system?
And I said free banking. I didn't even think I was going to get into free banking, but hold up. What did Jasper say? I think Jasper's a pecan. Let's see. Da-da-da-da-da-da-da. I'm not even for free banking, but I would just focus on market signals here. In competition, there's almost a sink or swim mentality in the sense that you need to constantly be innovating, and we don't even know how to calculate perfect price. That's what I was. Yeah, Jasper, I was trying to say that, but
Yeah,
but like, yeah, well, like I guess like even then, like okay, it's possible for tech.
Justin, when he said that, like, economic requirements like in backing, I wanted to fucking off myself.
He's like, he knows how to debate. That's what, like I don't know how. Like he knows how to debate. Like he knows how to like throw your like completely throw your shit off.
I'm gonna end the stream then.
Yeah.
Everyone, if you're still watching, thank you so much for seeing the whole debate. In my opinion, Justin took the dub home for VH. Good job, Justin. In conclusion, free banking is very based. So everyone, enjoy your nights.